Hello, I'm Donald Leggett and welcome to this edition of Share Views brought to you by London South East. I'm joined in the studio by Hayden Locke, CEO of Emmerson, the AIM-listed group who are developing the world-class Khemisset Potash project in Morocco. Welcome, Hayden.
Thanks, Donald.
So we're here to talk about your last quarter. It's been a busy time.
It has. We've made a huge amount of progress. I think we continue to tick off all those milestones on time, which is always nice to do as a management team. And we're making some pretty good progress towards that eventual delivery of a feasibility study.
To what extent would you say you've begun to de-risk the Khemisset project?
It's a gradual process, I think, the de-risking. We are gradually making progress towards getting to a point where we can finance and move into detailed design and engineering and then construction. So it is a gradual process, but we're certainly making progress.
What I noticed in your last newsletter, you talked about a 230 million debt financing deal that you've potentially struck with a European bank. Now that sounds fascinating. That's a big deal in your world. Tell me more about that.
Yeah, it was an indication more than a sort of a firm deal from the bank. So the bank approached us and said, look, we want to talk to you a little bit about your project. Would you like us to have a look and see what sort of debt levels we think we could get on it? Mm-hmm. The fact that it was more than 50% of our the total capex for the total project is really encouraging, especially when you consider the price scenarios that they ran through their financial models. They were very, very low pricing models. If we get anything above that in our offtake, then we'll certainly be able to increase our debt ratios on the project, and it makes just the financing story a lot easier.
It was an indicator. So what would it take to actually firm that up?
So
you saying yes?
Exactly. We saying yes. We engaging with the banks. We probably need to be a little bit closer to the point where we're actually going to move into construction to start engaging firmly.
You actually really need to be able to use it, don't you?
Exactly. But the big item to go through is a full, detailed, independent technical review, and then go through and document all the loan agreements and things. That typically takes about 12 months to do. So it's a process that we'll be starting sometimes toward the end of this year, I'd expect.
Interesting. And if you've got the 230 from one group, what does it take to get less from another bank?
Well, I think we would probably look at that as a single debt financing instrument. That would be the debt portion of our financing, and then we start looking at the equity side of that. Where does that come from?
So it's a balance. It's always a balance, isn't it? And you've got to decide the debt equity mix. Yes?
Exactly. We don't want to be too much debt because that starts to become a bit risky for the equity holders, which I'm one. But certainly we want to have enough debt in there that it's really supercharging those equity returns.
Okay. And let's quickly talk through the second quarter. There was a memorandum of understanding, which was to me seemed pretty significant. You have someone who's going to take 5 years of your output. That's terrific news.
Yeah, it's fantastic
Tell
news.
Me more.
I think what it really shows is there will be no problem for us to sell this product in the market. The market for the product that we're going to produce at Khemisset is enormous, and the markets that we're going to be targeting are the largest seaborne markets in the world. And so moving that 800,000 tonnes a year or thereabouts of product per annum is going to be absolutely no problem for us. And this MOU is with a large fertiliser player. We've still got to go through the final documentation and sort all of that out with them, but I don't see any real hurdles in us signing a final agreement with them to really distribute our product into the markets that we're targeting.
And you were talking about a figure of 290 million revenue. Was that in dollars? Was that dollar figure a gross figure or a net figure?
So that's a gross figure, that's revenue. So that's basically, assuming that the prices stay where they are today, we would make about $290 million a year of revenue per annum. So it's a very large project. I think what's even more interesting about the project is based on the scoping study numbers, 50% of that would be post-tax free cash flow to our equity holders. So it's a significant project and making a lot of money. We're talking EBITDA of north of $200 million a year. So a very, very cash flow generative project.
Happy days.
Very happy days.
You've been talking about pulling in a major strategic partner. Now, might that fertiliser producer and distributor be that major partner?
They could potentially be that partner. They have a large blending facility in one of our target markets, so they certainly are the have the potential to be a strategic partner. I think there are a number of others that could potentially fill that void as well. So we do need to be a little bit careful not to sign away our offtake agreements.
Sure, it's a competitive world, and you want to stay as flexible as possible. So who else might you be interested in having as a strategic partner? Who are the likely runners and riders?
There are a lot of fertiliser players. What we're looking at is the groups that are strategically very strong in the nitrogen and the phosphorus portions of the NPK blend, but not so strong in the potassium portion. Because what we see a lot in the market is there are a lot of fertiliser blenders downstream who really control the nitrogen, they control the phosphorus, but they don't have a good source of K. So we're targeting groups that have that sort of strategic angle to them. So if you were thinking about the regions, anywhere that there's cheap gas, they're likely to be very competitive in nitrogen. So that's all of the Gulf states, the Middle East, so Qatar, Saudi Arabia, the UAE. Certainly there is an obvious potential strategic partner in OCP in Morocco, who are one of the world's largest phosphate producers but don't have any production of K. And then there are a number of others predominantly through that region around India and the Gulf states that we can
OCP have got to be very interested in you, given that you're actually a Moroccan producer.
Absolutely, and I
they're
think
Moroccan.
Yeah, absolutely. And if you look at the import profile for potash over the last 5 or 6 years into Morocco, it's been growing at about 120% per annum in terms of demand growth. All of that going to OCP. Last year they imported 750,000 tonnes, and they're talking about increasing their consumption of MOP to 2 million tonnes a year by 2025 or thereabouts. So strategically it would make a lot of sense for us to partner with OCP. We know them very well. All of these things tend to take time.
But as you say, you want to stay competitive, keep your options open.
Correct.
Okay. Feasibility study. We've sat here and talked about your feasibility study commencing. What kind of progress are you making with it? How much can you tell us about progress?
So it's progressing really well. We guided the market that it would be finished within 9 to 12 months, which put us in the first half of next year, so sometime before June of next year to finish and release the results of that feasibility study. I'm fairly confident it'll be the front end of that 9 to 12 months time horizon, so that puts us somewhere between March and April, I would hope. It's progressing exceptionally well. We've done a lot of pre-work, which is mostly the optioneering, so working out which option is potentially better, because there is always an economic answer for an option, and that's all going pretty well at this stage. So
you see your costs coming down?
We haven't got into the detail on the costs yet, but I would expect there'll probably be some swings and roundabouts. There'll be some areas where costs go up. There'll be some things that we haven't accounted for in the scoping study, maybe some changes to the project, and then on the other side there'll be hopefully some reductions as well.
In your last quarter, you've also completed a metallurgical study. Put those results in context for us, if you could.
Yeah, that's a huge piece of news for us as a company. I think sometimes gets missed by non-mining professionals.
It's not so sexy.
Exactly, just how important that is. It basically tells us that the ore that comes out of the ground can be turned from ore and into the saleable product, i.e. remove all the bits and pieces that we don't want and turn it into the final product that we do want to sell. So that metallurgical test work program confirms that we can take our ore and turn it into MOP for saleable purposes. That is huge news, not just for the fact that technically the project stacks up, but also it means that the debt financiers will be having one eye on that, and larger equity investors certainly will have one eye on that as well. So it is really one of the biggest de-risking items that we've delivered in the last 12 to 18 months, is that metallurgical
without that,
work.
you wouldn't have a project, basically.
Well, you could potentially have a project, but it just means that you might have to make wholesale changes to your processing methodology, and then we're back to square one in terms of our understanding of the potential operating costs. What we got from this metallurgical test work program is confirmation that the process that we've used is viable, and so therefore we have a fairly good idea of what our processing costs are going to be based on that information, and that's going to be quite similar to what we saw in the scoping study, we hope.
Okay, what I am always fascinated about, despite all these successful milestones that you've hit, contemporaneously you're hitting all these different studies, it's all going well, but nevertheless you're still dependent on your AIM shareholders to keep you financed. So in July you raised $2.5 million. And tell me about your relationship with your AIM shareholders and what that money gets spent on. What does that money get used for?
Yeah, I think we probably caught the market a little bit by surprise with we raised 2.25 million pre-costs. It was fantastic. It was oversubscribed, which is unbelievable considering market conditions. We had a number of larger institutions come in, and then a few ultra-high net worths follow their position, one of whom, Anne Gloag, became a notifiable shareholder, holding over 3%.
As a Scotsman, I'm very familiar with Anne Gloag.
Yeah.
She's a bit of a legend in Scotland, is Anne, yes.
Well, she's a bit of a legend in the UK, I think. So, it was fantastic to see that support.
Good people to have on board.
Exactly. And we were fully financed for all of the work that we had ongoing. But what we saw in the future is we're potentially going to get into a scenario where we're going to be having some strategic discussions, and we don't really want to become a raise during those strategic discussions where share price is quite important. And as we often see, the moment that you are looking to raise money, your share price tends to fall a little bit, and we just didn't want that share price pressure towards the second half of this year.
And where are you in terms of your balance sheet?
So we have about £3.5 million left in the balance sheet. Drilling is now finished, so we're not going to be spending a huge amount of money there. So we're in a really, really good financial position, certainly financed for all of next year and a long way into 2021 as well.
The share price, I suspect you're going to tell me it doesn't reflect the value of the project. Would that be correct?
Absolutely. I mean, I think there are a lot of stories. This is a case where the market is suffering, and people are selling everything, not just the best stories. But typically, what happens psychologically is the best stories get sold first, and I think that's what happened with us.
At what point do you think the share price will reflect the value of the project? Will you have to actually virtually deliver the project before it starts to balance out and you get a truer value?
It's very difficult to say. I think, I think we're driven a lot by market conditions at the moment and what's happening in the world, and there's a lot of uncertainty at the moment. So
that's not a good thing then.
No, it's very, very difficult to say where we're going to end up, but I think we're going to keep chipping away at it. We've got a very strong balance sheet. There's no reason for us to slow down, and we have a lot of good things going on behind the scenes that will lead us to hopefully further de-risking and milestones that will encourage investors to buy our
Instinctively,
shares.
I would think that the best projects are the ones which are going to survive these difficult times, and I would hope you would, I suspect you would regard yourself as one of the better projects. So.
Yeah, and I think the reflection is that we went out to raise 2.25 million and we had an oversubscribed book for a raise in what is a very, very tough market, I think is a reflection of the quality of the project. And so I'm very confident that this will survive, but how long does the cycle remain as it is, I don't know.
Where are we in the potash cycle then, if we're talking cycles?
So the potash cycle is actually very strong at the moment. We've had 3 years of 2 years of record demand, and this year is going to be another year of record demand for potash globally. The prices are relatively strong, relatively stable. The demand profile for potash hasn't changed at all, so that underlying agricultural theme, which is driven by growing populations, is still very much intact. And I think you see, certainly in the fertiliser space, most fertiliser industry players are much more bullish on potash than they are on the other fertilisers. So it's a really good place to be at the moment. But I think it's one very small part of a greater commodity sphere that has been under pressure. And then if you look further afield, there is a lot of uncertainty with the ongoing trade wars and things with.
What would the outlook be for potash? 1 year out, 2 years out?
So again, very, very strong. Most of the major producers are predicting that it'll grow at 3.5% per annum over the next 5 to 7 years, which means that for every year, basically in the next 5 years, we're going to be hitting new records of demand in potash. It tends to not be as violently cyclical as other metals and mines. So it's a fairly good place to be for the longer term.
Final question. What do you see coming up in terms of news flow? Do you have anything, big coming up in the next 3 months, 6 months, which is going to kick?
Yeah, so we have a resource upgrade, which will be mostly about moving it to the measured and indicated category, and that's with one eye on releasing a reserve when we release the feasibility study. That should be out sometime, hopefully in September, maybe early October. We've got a number of strategic partnership discussions ongoing in country that are more around, you know, electricity supply, transport and logistics. Hopefully we'll be able to release a few things on that. And then the big bits will be when we start breaking down the feasibility study into the discrete components, as we did with the scoping study, and releasing those to the market, so that people can see, you know, as you ask the question, are your costs lining up? We'll be able to show, yes, they are lining up, or they're slightly above or slightly below where we were in the scoping study. So really starting to paint that picture that the numbers that are going to come out of the feasibility study are once again very, very low capex project for potash markets, and hopefully a very high margin project as well.
Okay, that's it for today. Emmerson Locke, fascinating as ever. That's the CEO of Emmerson Plc. If you'd like to see more interviews like that one, do subscribe to the London South East YouTube channel. Thank you very much indeed.